There's a tax idea so uniquely Australian that overseas investors genuinely struggle to believe it's real. It's turned up at nearly every federal election. It once helped decide one. And most of the Australians who quietly benefit from it couldn't explain it to save their life. Franking credits. By the end of this, you'll be one of the few who actually can. Here's why you should care. If you own any Australian shares at all, directly or through your super, which is basically everyone watching, franking credits are quietly working in your favor right now. They're not a loophole, they're not a rort, they're actually a fix for a problem most of the world never bothered to solve. So let's start with the problem. The problem franking credits solve is simple, getting taxed twice on the very same dollar. Picture a company you own a slice of. It earns $100 in profit. First, the company pays tax on that profit, 30%. So $30 goes straight to the tax office. Then it hands you what's left as a dividend. And in most countries, that dividend gets taxed all over again at your personal rate. Same $100 taxed on the way out of the company and again on the way into your pocket. Australia decided that was a bit rough. So back in 1987, Treasurer Paul Keating built a fix. Keating's fix is called dividend imputation, and the everyday name for it is the franking credit. Here's the whole trick. When the company pays you that dividend, it also hands you a little receipt that says, "We already paid $30 of tax on this for you." That receipt is the franking credit. So on your $100 of profit, you get $70 in cash plus a $30 credit for the tax that's already been paid. Watch how that plays out. Now, the credit does something clever at tax time. You don't just declare the $70 you pocketed. You add the credit back on and declare the full 100. That's called grossing up. Then you're taxed at your own personal rate on that 100, but you get to subtract the $30 of tax the company already paid. So if your tax rate happens to be exactly 30%, the same as the company's, the credit covers your bill completely and you owe nothing extra on that dividend. The double tax is gone. But here's where it gets genuinely strange. What if your tax rate is lower than 30%? Say you're retired with very little other income and your rate is basically zero. The company still paid $30 of tax on your behalf, but you owe nothing. So the credit is now worth more than your entire tax bill. And this is the part that makes the rest of the world raise their eyebrows. Australia doesn't just wipe your bill to zero. It pays you the leftover $30 in cash, a refund for tax you never personally paid in the first place. Almost no other country on earth does that. So watch the same $100 dividend land on 3 different Australians. The retiree on a 0% rate gets the full $30 handed back as cash. The worker on 30% has their bill exactly cancelled. Nothing to pay, nothing back. And the high earner on the top rate, the credit covers part of their bill, but they've still got a little left to pay. Same dividend, same company, 3 completely different outcomes, depending entirely on your own tax rate. That one feature is the whole reason franking credits are so loved and so fought over. Because that cash refund isn't free. It comes out of the federal budget, billions of dollars a year, and a big share of it flows to retirees and self-managed super funds who pay little or no tax. So in 2019, one side of politics went to an election promising to scrap those cash refunds, branded by its critics the retiree tax. The argument for scrapping it, it's a huge cost, and it mostly benefits people who are already comfortable. The argument against, without it, low-income shareholders get taxed unfairly on profit where the tax was already paid. That election was lost, and franking credits survived, untouched. Even the big 2026 budget left the heart of the system alone. It's become a genuine third rail of Australian politics. So what should a normal person actually take from all this? 3 things. 1, franking credits aren't free money, and they aren't a trick. They're simply a refund of tax that was genuinely already paid, so you're not slugged twice. 2, for most people, it's automatic. Your dividend statement shows the credit, and your tax return sorts it out without you doing anything clever. And 3, there are conditions, like having to hold the shares for a minimum period to claim bigger credits. So if dividends are becoming a real part of your income, that's the point where a registered tax agent earns their fee. So next time franking credits come up at a barbecue, in the news, in the middle of an election campaign, you'll know exactly what they are. Not a loophole, not a scam, a 40-year-old fix that stops the same dollar being taxed twice, with one unusually generous twist that hands cash back to people who've already paid their share. Quick, honest line as always. This is general information about how the system works. It's not tax or investment advice. And for your own situation, a registered tax agent is the right call. But Australia's weirdest, most argued about tax perk, you've officially got it now. This whole channel is just this, pulling the Australian money system apart, one weird, argued about piece at a time. Plain English, nothing to sell you. Next one, HEX, the student debt almost every graduate carries, almost nobody really understands, and that quietly grew on a lot of people without them noticing why. If you want that, subscribe and send this to the one person who keeps mentioning franking credits like they know what they mean. See you in the next one.